Okay, we'd like to welcome everybody to Fluent Financial's first webinar of 2022. Hope everyone had a good Christmas and holiday season and New Year's. Hopefully not too many of you got COVID, and if you did, hopefully you had a good outcome. Omicron is significantly much more contagious, but a lot less virulent than in the previous versions. And if we believe the science, this may be the last major wave we have to go through. Anyway, so joining me on the call today is Mike Lanise, the head portfolio manager for Fluent Financial. And as our normal webinars are for the first quarter of the year, these run a little bit longer. We have a lot more material to cover. We're going to talk a little bit about what we thought would happen in 2021, review some of the results of the portfolios. Then we'll talk about significant economic events that we expect to have happening this year. Inflation, how that's going to impact the markets. Very small part on COVID. I'm tired of talking about it, as everyone is to hear about it. So if you guys have any questions, there's a speech balloon. You can type your questions in and we'll answer them at the end. We have everyone muted now. We'll unmute the mics and stop the recording at the end to do a Q&A session. So we'll go ahead and get started. First thing, I'll let Mike kind of talk about the 2020 slide here and what we were thinking about a year ago and what happened.
Yeah, hi everyone. Thanks, Mitch. Yeah, so last year, this is from our December 16th presentation, and a couple of things that we said were going to occur because we were still unsure. We were still in that panic. I mean, we were only 10 months into COVID, and we weren't sure what was going on. So we were talking about children returning to school. We were talking about the election results, that it's still been unknown at that point. We talked about a COVID vaccine being approved and widely available. June 1st, travel season was going to pick up again, was one of our predictions. And then oil demand would continue to increase. Now, in hindsight, none of these are edgy predictions, but these things all occurred. And if you look on my slide here on the far left, next 7 months, that's when we had the presentation. 1 month prior to that is when the vaccines started to be announced. So we're 1 month into vaccines at the beginning of this chart. And if you look about midway down the chart, FDA grants Pfizer vaccine approval late August of 2021. During that time, the S&P was up 20%, while the Dow Jones was up over 16%. Crude oil was up 51% as demand continued to grow. And then we got popped with the Omicron variant at Thanksgiving. So, but if you look at where we are today versus where we are around Thanksgiving, we're very close to those levels. If you want to go on to the next slide, Mitch, we talk a little bit more about our performance this last year in 2021. So what you see across the board here, these are grouped into this is our actual performance versus the benchmarks. And so our top 4 portfolios there are our ETF portfolios with some sort of blend between equities and fixed income or bonds. The middle 3 are all our call writing portfolios. And we do some call writing on the top 3 of the top 4 portfolios, but mostly our option writing are those middle 3. And then the bottom 2 are strictly our stock portfolios. So the third from the last column is going to be our performance. The orange column is going to be the benchmark. And then finally, the third column is whether we're outperforming the benchmark or not. And all of these performances numbers are from Orion after fee performance numbers. So our largest portfolio is our value and opportunity, second from the bottom. And we kept pace with the S&P. What happened is we were beating the S&P by about 3% going into the last 6 weeks of the year. The Omicron variant hit. We were heavy in oil. We still had not cycled down our oil position, and that brought us down in line with the S&P. But pretty much for 2021, we were definitely outperforming the S&P by several points. Our other big portfolio on here is our stock income portfolio. Now it traded, we had a couple of beat up securities in that portfolio in 2021, but we still returned 14.5% on the portfolio and generated a little over 14% in free cash flow. And remember, that portfolio is not designed to outperform anything. That portfolio is meant to churn along and generate cash for the people that need retirement solutions. So we feel pretty good about these results. And finally, our largest winner was our municipal bond portfolio. It beat its portfolio, the growth within communities, by over almost 3%, 2.72% this year. So all in all, it was a very good year for us.
Yeah, thanks, Mike. And just to let everyone on the call know, the market had a very strong year last year. No one's predicting a 20+% return this year. You're going to be looking at much more muted. Historically, the rates of return on equities are anywhere from about 8 to 11%. So this was a phenomenal year. But stocks are still going to be the place you want to be medium and long term for your portfolio. So let's talk a little bit about what we think is going to happen in 22, Mike.
Yeah, and so when Mitch asked me to put together, what are our market thoughts? Our market thoughts come from our own analysis. A lot of different analysts on the street. We kind of pull it all together, see what makes sense. We talk about it, and we make some predictions. And obviously, our predictions are not going to be next Tuesday, the market's going to go up 50 points. We'll try to be a little bit more broad and a little more general in our thought process here. So the S&P returns, experts are saying somewhere between 8% and 12% this year. We think it's going to be in that low double digits, so 10, 11, 12. We agree with that statement. Interest rates are going to continue to rise, and I have some slides on that. We're going to talk about that. But the Fed, I think, is starting to feel a little bit embarrassed that inflation has stuck around so long, and I feel like they may be trying to do a little catch up here in 2022. Bonds are going to be a drag on the portfolio. Anytime you have interest rates rising or a rising interest rate environment, bonds are going to get hurt by that. Inflation, we think it's going to be peaking here in early 2022, and that supply chain is going to release more of a supply glut. Now, there's a caveat there. If China decides to shut down production, we get a lot of things from China, and if that occurs, if something wacky goes on in China, we could see an extension to the supply chain concerns. But I think those will also, so we're talking about a difference between second quarter in 2022 versus fourth quarter in 22, things coming open again. This Omicron virus doesn't stay around long, super infectious, hits hard, and then is gone. So I expect us to get through this in 2022. Market volatility will continue and be abnormally high this year, and local economies are going to continue to open up. You still have some of our major economies like California and New York that are shut down, and our GDP, our gross domestic product, is still doing well with those shutdowns. Once those folks can continue to open up, whether it be community by community or an entire state, England just said they're going to wipe out all of their COVID restrictions now. Once that happens, we're really going to see some growth in our economy again.
Yeah, one thing on the supply chain I'd like to add, there's a term called bullwhip effect. And the bullwhip effect occurs, and we had this in 20 and in 2021, where you had a shortage of supplies, which caused inflation because of high demand and low supply. And you had just-in-time inventory controls in place, which is financially very good for keeping costs down. But when you have the COVID-19 pandemic, it really disrupted that chain flow. So that's created issues. So we think what we're going to see happen with inflation, the reason why we think it's going to peak in the early part of this year, two things are going to happen. One, the year-over-year comparisons will come into play, and you have a much larger denominator, so the change won't be as high. And then secondarily, that bullwhip's going to flip over on the other side. You're going to have excess supply, which will cause prices to drop. So that's what we anticipate happening. We had talked about, is the inflation to be transitory or much more permanent? And it's going to be much more permanent if it shows up in wage growth, and that's what we're seeing happen. And then plus we've got a record number of job openings, and our government, while I know they wanted to be accommodating, I think they went too far by paying people not to work, and a record number of people have left the workforce. And there was some information that came out today that's a little discouraging, that the number one reason why people are leaving their jobs is because of diversity and inclusion policies their companies have adopted, which basically they throw meritocracy out the window and they value other quantities, which is very disturbing. So, Mike, let's talk a little bit about some changes we've made to our equity portfolios.
Yeah, so every year and then multiple times a year, we discuss what we want to do with the portfolio. We do rebalances usually intra-year, and then we do a reconstitution of the names in the portfolio at the end of the year. And so for our ETF portfolios, we look at that on more of a macro basis. And one of the things that we had done initially in 2021 was said, okay, US is doing well, Europe's going to catch up now. Well, Europe never caught up. And I don't think Europe's going to catch up in 2022. So what we did is we further reduced that position we initially had increased in developed countries, foreign countries, non-US countries. During 2021, we had inflation hedge. We did not want to do gold. We used emerging markets, and we have since stopped that trade altogether. Anytime you get into an emerging markets type ETF, it's going to be somewhere between 30 and 40% China. I don't want to mess with China right now. I think China's a disaster. So then our bonds, we didn't make any big changes to bonds. We said bonds were dead last year. I think bonds are even more dead this year. We're going to continue to see these rising rates and hurting bonds. So we have exposure there. You want that diversity, but we try to limit it as much as possible. Our equity portfolios, our equities we do, instead of a top-down global view, we look at specific companies that we like, and then we plug them up, a bottom-up type approach into what the S&P has. So if S&P is represented by 10% of the industrial sector, we pick our industrial names, and then we plug those up in at about a 10%, or if industrials we want them to be more, we put them at 12%, or and you tweak the numbers a little bit based on what you think is going to happen. So down below, I have two pictures. The one on the left is going to be the different sectors in the S&P and where we were going into the end of 2021 as far as a weighting. So if you see 14 for energy, we were at a 14% energy holding. And when we rebalanced on January 3rd, we went down to a 7% energy holding. Now, if you look at the chart on the right, you see energy is highlighted in green. The reason energy is highlighted in green is because the S&P is still around 3% energy while we're at 7%. So we are heavy 4% in energy. So those are those three columns. You got what the S&P was in December, where we are now with our stock portfolio, and the difference with the S&P. Infotech is highlighted in red because that's where we lag the most as far as our weighting. We're weighted 24% into information technology, which is a heavy weighting. That's a quarter of our portfolio. But still, the S&P is up at close to 29% on their weighting. Now, I'm just not comfortable with that. And we've seen the markets, particularly tech and the NASDAQ, get hit here at the beginning of the year. So it's been a pretty smart move to underweight something like that, whereas energy has been going gangbusters. So it's pretty smart for us to stay overweight there. If you look at some of the other things that we have in here, I'm sorry, Mitch, can you? Thank you, sir. We realigned our healthcare and consumer discretionary a little bit better with the S&P 500 weights. And then we also had increases to information technology, financials, and the real estate investment trusts. So just giving us a different exposure. We're trying to get more in line with the S&P. We were just so heavy energy in 2020 and 2021. We're just doing some profit taking at this time and realigning our portfolio.
So let's talk about how the markets have performed since Thanksgiving and Omicron.
Yeah, since November 19th, the NASDAQ is down over 10%. And since the Jan 3rd record high, the S&P is down over 5%. So why is that the case? Well, here's what happened. On January 5th, the Fed minutes were released, and it turns out that the Fed is much more hawkish than has turned much more hawkish about raising interest rates. So when you are a growth company, which is what the NASDAQ typically is, versus a value company being a Caterpillar, that's an established company, pays a solid dividend year in, year out. A growth company is going to be your startup internet company that takes all of its money and puts it into capital investments back into the company. Well, they're borrowing at interest rates, and if rates are going up, it tends to hurt their growth perspectives. That's not the only reason, but when that happened, you really saw tech get hit pretty hard, and that's that purple line there. You see NASDAQ getting hit so hard since the first of the year. Biden's Build Back Better bill, that's going to probably end up being replaced with a watered down version. But that was scaring the economy because that was going to be additional stimulus into the economy if that did pass, also driving up inflation and prices. So the Fed is just now trying to get a handle on things, and fears of the Omicron variant and fears of these rate hikes are really what's spooking the markets right now.
So let's talk a little about the 2-year and 10. And this is a chart that I like to look at, because if the 2-year and 10-year slope gets inverted, it can be a harbinger of a pending recession. So what we have on this chart right here is, if you go back here, when the yield curve inverts, it means the yield for the 2-year note is higher than the 10-year. And this was in August, September of 19. And sure enough, and it's just more of a coincidence because no one even knew about COVID, in March of 2020, we entered a very steep and very short recession. And this is where we are now. So we're at 83 basis points, or 0.83%. So nowhere close to being inverted. But this is just something we like to keep an eye on to see. But we don't anticipate any kind of recession prior to 2025. And I'll show some information later in the presentation that backs up that statement. Mike, why don't you talk about the struggles and what's working well so far year to date?
Yeah. So this is just quickly those sectors that we were showing on our rebalance page. Energy and financials are going to be your top two there, doing well so far. Really, energy is running away with it. The crude is up almost 11.5% through the first part of first 2 weeks of the year, and your U.S. Treasury yield has gone from 1.5% to over 1.85%. So that Treasury yield is up almost 25%. And then because of that, you're going to have your real estate, healthcare, and technology getting hardest hit. And we've talked about that. Those not so much healthcare, but really real estate and technology are very much affected by an increase in rates.
Yeah. And continue the technology theme. You can see that 50% of the NASDAQ members have had a 10% drawdown this year. And Mike, why don't you explain this 48%, why that's highlighted?
Yeah, so that 48% is the number of members with at least a 10% drawdown. So I don't know if you guys remember back in 2020, when the market bounced off of the March 23rd low, what you had was the FANG stocks leading the way. So the FANG stocks were up, five stocks represented over 30% of the S&P, made it look like the S&P was recovering when the broader market was not. The significance of this 48% is that this is a broad technology sell-off. It's not specific to 4 or 5 of your largest companies. And that's all we wanted to show here, is that this is just broad-based, everything selling off, all ships are sinking when the tide goes out.
Yeah. Okay, so let's talk a little bit about the PE ratio. And this particular slide here is shows the stock price over earnings per share. And as we came out of the COVID downdraft, you had a big spike in the PE, and the market became overvalued. But what's happened over time is the earnings from the companies have come in, and they've been fairly strong, and the PE ratio has come down. Now, this has come down since the beginning of the year, since the market's come down. So the market is still slightly overvalued, but not as much as it was a year or so ago. So the market's more fairly valued. And one of the big reasons for that, as I mentioned, was earnings have been real solid. And why have earnings been solid? If you look at this bar chart, the gray represents margin. Look, if you see this 72% margin, it's the highest it's been in over 20 years. So companies say, oh, there's inflation out there. We can increase our prices and we don't have to worry about losing market share. And so they did. Because for years, growing top line revenue was a huge challenge for companies. And as you can see here, even revenue had a really solid year. Last year, I guess margin was 55 and revenue was 17. So that was a record year for companies. So basically, the earnings helped support the stock prices. So we don't see a major meltdown happening. And the next thing we would like to talk about is the impact of rising interest rates. Is that going to have a negative impact on the stock market? So what we have here is, if you look at, higher rates are usually bullish for stocks. And if you look at the boxes we have highlighted here more recently, 96 forward, and this is the change in the 10-year yield, and we're about 1.8, 1.9, and how long the duration lasted. This was the impact on the S&P during this interest rate increases. So we don't really see interest rates, rising to create a negative impact on the markets until the 10-year yield hits 3.6. And I have a chart later. I'll show you that. In terms of volatility in the marketplace, we normally have an average of 62 days when the market moves 1% up or down. Last year was a more calm year. 2020 was obviously very volatile with the advent of COVID. We expect 2022 is probably going to be probably closer to 2020 and the average with the volatility. So that's anticipated. A lot of people say, well, if we have these big drops, what does this mean? How long do they last? How often do they occur? And according to Bloomberg, this 5% drop normally occurs 3 times a year, and the duration length is 40 days. The last time we had that, it was back in October 21. It lasted for less than a week. And during these times, we like to do Roth IRA conversions. JP Morgan says this happens 5 times a year, but that's a good time to do that. But you can see a 10% drop, which is technically called a correction, happens about once every 16 months. It lasts about 132 days. The last one was March 2020, obviously with COVID. And then 15% and then 20%, the duration here, all this happened because we had about a 34% drop in a very short period of time because of the COVID pandemic.
And we're dealing with that 5% issue right now with the S&P, Mitch. So that would update this file because it just happened today. It closed more than 5%.
And for those of you on the call, we're probably going to be moving, doing the Roth conversions for those of you that are set up and doing that here over the next few days. That was actually in my calendar to talk about tomorrow, but we've been in meetings all day today. All right, so the probability of positive returns. Again, the longer you're in the market, the higher likelihood you're going to have a positive rate of return. You get 3 and 5 years, 80, 90, almost 100% for 10 years. You invest in the market for one day, it's basically a flip of the coin. You can have more money at the end of the day or not. So just, stay invested longer term. People on this call are very good about that. But a lot of times people are worried about volatility. If you're coming out in cash and you're a newer client, this is a way to assure you that you're going to be fine longer term. Don't look at the market day to day. It's not good for your blood pressure. This chart here, we are in the second year of a 4-year presidential cycle. So this is the mid-year term. And what's interesting here is if you look at the volatility of the marketplace, normally you can have a down of about 17.1%, but then a recovery of 32%. So you see a lot more volatility in the midterm election year. And I think because of COVID interest rates rising, you're gonna see this volatility happen this year as well. So Mike, anything you want to add to that?
That's it. Just hang on. I mean, think about how many of you guys bailed on the markets in March of 2020. None of you.
None.
Thank goodness you didn't. Look what the market has done.
Yeah.
Just
And what I would say is I can't tell you how many calls we got from clients who said, hey, I've got, 20, 30, 50 grand. One client had $500,000 and they invested, at the end of March, beginning of April, and they've got huge returns because they bought in when it's cheap. So when the market goes down, the market's on sale. And those of you that are older, remember Kmart blue light specials. That's basically what's happening when the market takes a dive down. It's a great time to deploy capital to do that. So next thing we're going to talk about is we're going to get into inflation and the impact. And the CPI change, looking at the 3 years, now pushing 3.3, and it's really jumped up. And this was done as of November. It was 6.8. This number is now 7%. And that's the highest inflation's been in 40 years. And Mike had said this earlier, the Federal Reserve, I think, is feeling they've been asleep at the switch, and they should have acted sooner on our federal government barometer. I think they kept too much spending in place, which created this labor problem and also probably created this wage growth problem. And some of the people on the right will say the left's trying to buy votes, but it's the bottom line is we got an inflation issue that we're going to have to deal with, and it will get better this year. But the middle class and the lower class Americans, they have a much harder time dealing with inflation than people that have more resources.
it's my opinion, Mitch, that this inflation is peaking. That chart said 6.8%. That was November. December's reading was 7%.
Yep.
So we're seeing that steep line up really starting to level off. And once these supply chain issues go away, I think we're at the risk of seeing a supply glut.
Yes, and that's that bullwhip effect that we talked about. And in terms of like, hey, where should you put your money to offset the impact of inflation? Commodities historically have been the best place to combat inflation, but the stocks are in second place. Last place is bonds, and that should be fairly intuitive. One advantage of inflation on bond prices, the more conservative investors who want to be more bond heavy, as the interest rates go up and bond prices fall, we can reposition more money into bonds as they become cheaper. And commodities, a lot of people think of gold. Gold hasn't done super well, and you can look at something like oil has actually obviously done well, but and then emerging markets. But as Mike had mentioned, emerging markets is so heavy in China, and China had a horrible year last year, and they have all kinds of problems because China has adopted this very strict lockdown policy that's really hammered their economy. Plus, some of the debt problems they have with Evergrande and some of the other places, they have very opaque accounting principles. I know there's been a movement to delist some of the Chinese companies from the exchanges because they don't want to follow the Sarbanes-Oxley and Dodd-Frank rules, which they should have followed from day one, but because they paid off politicians on both parties, that didn't happen. But they're seeing that the corruption of China is now becoming more obvious to the world. So let's talk a little bit now about employment and wages. You can see the big spike. The dark line represents the unemployment rate going back from 1970. And you had the big spike up here in April 2020, then it's come way down. And now we're at 4.2, and a lot of people say we're close to full employment. The wage growth, and you see the spike here in the blue line, the 50-year average is 4%. We're at 5.9% now. And the concern is it may continue because of the shortage of workers out there and the big numbers of people that have just permanently left the workforce. Many of you on this call, because of the growth in your portfolios or the value growth in your homes, have hit your number and you can retire. That's true for a lot of Americans across the board. Plus, with this, diversity, inclusion, and political correctness and wokeness, a lot of people that are I hate to say this, white and older, are not welcome. And they said, why am I going to put up with this crap? I'm going to walk out the door because I can. So it's going to affect it, mainly the bigger companies and institutions are impacted by that more than smaller corporations. And then the vaccine mandates, over 100 employees, Supreme Court shot that down, but not for healthcare. So the government overreach is becoming a bigger problem for lots of people. Inflation, we've talked about this. You can look at the headline CPI, and again, that reading now in December is 7%. You know, the headline in the core PCE deflator. These are numbers the Fed looks at. You know, their goal is to keep it at 2. They decided to say, we'll let it run above 2 for a period of time, but just look at this spike. And what's happened is this has spiked up a lot more than they anticipated. And historically, if you study the Federal Reserve and how they make decisions, normally their timing is not very good. One thing I will give the Fed credit for, they provided tons of liquidity when COVID hit in March of 2020. And unlike the Great Recession, when we didn't know what to do, where they didn't provide the liquidity, and it caused the banks and the financial institutions to lock up and caused people to have to sell hard assets for pennies on the dollar, which really made the recession of 08, 09 much worse. So the Fed learned their lessons and provided liquidity, so we had a much less severe recession. And you know, the previous administration, which has a lot of business people who came out of that sector, made better decisions that kept us out of having a bad recession. So that's worked well. Labor demand, we've talked about this as the JOLTS report, job openings. You just see this hockey stick, you know, 11 million jobs. And here's the people that have quit. And a lot of it has to do because of the housing market and the stock market. And look at the layoffs, the lowest it's ever been. It's almost like if you have a pulse, you can have a job. They just need people. I was calling a doctor's office, or a couple of them today, to get an appointment. I was on hold almost 30 minutes. And I just was doing other work while that's going on. But that's just indicative. There's not enough people to do, you know, the more of the entry level basic jobs, and it's just a problem. And those even in the call probably had the same experience. Mike, why don't you talk about this chart? I think this is really important. You kind of hinted about this earlier about where the unemployment is. It matters one part of the country you're in.
Yeah, thanks, Mitch. Green is good, red is bad. Think of it in those terms, and everything else is cautionary. So what you have going on is two of the largest participants of the gross domestic product of our country are California and New York, and they are still dealing with lockdowns there. So one of the things I said earlier is that communities, neighborhoods, towns are going to start opening up, and that is going to increase the strength of our overall economy in 2022. People are saying, wow, whether you wear a mask, don't wear a mask, vaccinated, boosted or not, you're getting this Omicron variant. This thing is hitting everybody, and then they're fine. So the results of it are it hits quick, it spreads rapidly, effects of it are mild, and now you have immunity. And once that is realized by the California, New York's, Illinois of the world, and what is that? Is that Wisconsin there, Mitch?
No, it's Michigan, Mike.
Oh, Michigan. I'm sorry. I need a geography lesson, which is crazy because I know Detroit and Toledo are right by each other, and I grew up in Ohio. Anyhow, so once these parts of our country all start opening up, I think you're really going to see what's already a strong GDP right now coming out of the recovery really get some tailwinds behind it.
Yeah, and what's happening is there's been a record number of people that are leaving California. California's really got some big problems. You know, a lot of these states that are in red have homelessness problems. And what our government has done is they said, well, let's give a lot of money to the homeless instead of taking money away from them. And you're creating an incentive to be homeless and living on the street. And there was a case, it was Martin versus Boise, Idaho, and basically it prevented municipalities from arresting vagrants or homeless people and getting them off the streets. So now it is a rampant problem throughout our country, and it was generated by our government. So yeah, everyone wants to take care of the homeless, but you don't want to create an incentive for homelessness. In New York, they have opened up basically shooting galleries that the government pays for drugs for homeless people. You know, so how is that working? You're basically condoning illegal behavior and have the government pay for it. You know, what our government is doing is just, I just kind of shake my head. It's just
very different. Very different than the shooting galleries we see here in Texas.
Yeah, 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 absolutely. Thank God for the Second Amendment. Anyway, so I'll talk a little bit about COVID very briefly. We talked about, Omicron. It originated in South Africa. This is from the Worldometers. You see this big spike up at the end of November, a big case, and it's come down almost as quickly. You're going to see this happen worldwide. This is the first pandemic. This is Alpha and Beta. Here's Delta here, and here's Omicron. One interesting point, some of the Greek letters, or the next one after, like Delta and Epsilon, was G. They decided not to call Omicron G because that happens to be the first name for the Chinese premier. I don't know if there was any coincidence behind that or not. Anyway, so Mike had talked about this. It's not as deadly. You see the big spike in cases, but here's the deaths. It's very low. The R0 factor is very large. This case, or this chart here on the far right, shows vaccinated, infected, and vaccinated, which I was in August, infected only. You're at 90%. That's herd immunity. And again, the media doesn't want to talk about it because they, fear sells and the truth doesn't often. But Omicron, I think, will be the end of COVID. It will go from a pandemic to an endemic and probably seasonal. But I think a lot of people have probably around this call have had the Omicron. And what's interesting is that if you were vaccinated, you had a higher propensity of getting Omicron than if you weren't. So these vaccine mandates, I think it's more political control and politicians drunk on power than something that made good scientific sense. This is a heat map showing the global economy. Red is bad. This is the recession 08, 09. Here's the very short recession for COVID. You can see the green, lighting up across the board. Now the data is reported, but it shows the bounce back in our economy across the board. So the world's doing fine. And the next few charts are going to be from the ITR economist out of Canada, Alan and Brian Beaulieu. They've been around since 48, and they have a 94.7% accuracy in predicting what's going to happen in the next 12 months. And to kind of give you there's a lot of colors on this, a lot of wording. I don't need to read all that, but I'm going to focus on the colors and the phases. There's 4 phases an economic industry can be in. A is recovery, which is blue, coming out of a recession. B is accelerating growth. C, the yellow or gold is slowing growth, and D is recession. 12/12, this is as the end of 2021. Everything was in accelerating growth in the U.S. core economy. They're expecting a slower at the end of 2022. And what we're seeing happen is a lot of that slowness is going to be in the first 6 months of this year. It's going to be picking up into 23. You see much more green here, and then into 24. No red, no recession. So it's just going to be a little bit slower. And a lot of it has to do with the Omicron that wasn't expected, and then the higher inflation is slowing some of the growth. Global economy, very similar colors. From Europe and even China, they're expecting some kind of a pickup, but no red, which is important. The construction industry, very similar color scheme. You see some growth picking up in office and education. 12/12, we're going to have much more growth in 2022. Interest rates are still relatively low. Little bit of a slowing growth in 23, then picking up again in 24. Manufacturing economy. I'll focus here on the oil sector, which is down here, kind of in the middle. It's just starting to pick up, and it's going to pick up more in 22, and then in 22, 23. A little bit of red. U.S. defense capital goods and new orders. Historically, the Democratic Party is more pro-social programs and government, not as pro-defense as Republicans are, so that's not anticipated. But again, there's not a lot of red here through 24, which is good. And then the financial economy, ITR, they never want to predict the stock market. They always do rear view looking. They expect more volatility this year. Here in the bonds, because of inflation. It's going to be much harder for bonds, so much more slowing growth in the bond markets. They expect oil prices are going to be $80 a barrel for most of this year. And those of you that have been on these calls know that most of the frackers can make money at $40 to $45 a barrel. So that's going to be good for the oil sector. This part here, this is kind of a summary, and this report shows the trends of the 10 major sectors of the economy. So think of this as a train and a train track. The financial and the housing sector is kind of the engines that pull the rest of the cars. Non-residential construction in this picture is kind of the caboose. And we showed this on the October report. The order really hasn't changed much. The train just moved further down the track. What they're predicting is in 22, the soft landing, not going to the right with a hard landing. So you're going to have this in 22, then 23 picks up in 24. Slowing down 24, 25 is when they expect there'll be a recession. It will be more of a hard recession, similar to what we probably had in 08, 09, or 2000 through 02. Supply chain, we talked a little bit about this and the bulwark effect. You have slower delivery times. We're starting to see this edge over. It's getting better. And prices are rising because of strong demand. A big part of this is a lot of people that had money that would like to travel couldn't because of COVID. So they went on Amazon or the computer or home shopping network and bought a bunch of stuff they otherwise wouldn't buy. So as COVID abates, you're going to see people going back to the services, and some of the supply chain demand will fall. Plus, how many pillows or comforters can you buy? So I think that's going to help as well. The wild card in all this is China and how they handle Omicron. If they shut things down, that affects output that may have an impact on this. Mike, anything you want to add on this at all? I guess not. Then on oil, what we have here, it just shows the production, U.S., OPEC, Russia. The U.S., we expect to have much more production growth, about 12.4% since 18. Growth is going to pick up for OPEC and even Russia, and consumption is going to be increasing as well. This chart here in the blue line shows active rigs. So really since the middle of 2020, the rig count started to increase, but the inventories have been pulled down pretty significantly. Oil is about $75 a barrel at the end of the year. It's probably going to be around the $75, $80 per year going forward. So that's going to be good for Texas. The Fed has been, we talked about raising interest rates. This is the Federal Open Market Committee, and the Fed funds rate, the blue diamonds here, that shows them increasing rates going forward. And they're expecting, 3 rate increases, maybe 4, and another about 4 rate increases in 23. What's interesting is the market, which is the green diamonds, they think there's going to have these increases here, about maybe 5 or 6 increases, and it's going to stop here. The long-term goal for the Fed on the Fed funds rate is about 2.5. Right now we're flat, 13 basis points, 0.13 here. It's going to be interesting to see how this plays out. What we have found is historically in the last, say, 5-8 years, the market expectations have been more accurate than what the Fed expects. So sometimes I suspect the Fed is trying to talk up or down markets. So we talked earlier about when will there be headwinds, and that's going to have a negative impact on the stock market, and that number is 3.6. So when the 10-year Treasury yield gets to 3.6, that acts as a headwind for stocks. So we don't anticipate that rate getting up there anytime soon. Plus, our economy is still fairly strong. And when New York and California, Michigan, some of the states that are more locked down open up, that's going to further help our economy.
We're at about 1.8 right now, Mitch.
1.8. Okay, so we were about halfway there. I want to kind of end the last part of the presentation on some good news. Again, this doesn't get reported by the media because it's good news. Household net worth, this is 150 trillion with a T. Our federal debt is $30 trillion. And 2/3 of that debt is owned by people on this call Americans. They own it through ETFs, mutual funds, or they own outright treasuries themselves. So this is a really, really positive number. This number is real positive. Household debt service ratio. Back in 1980, when this was created, it was 10.6. Here's the Great Recession. Americans realized they can't live their lifestyle on a credit card in Dodd-Frank, and you just saw this big pay down, and it's been really, really low. And the reason why this is important, recessions have a tendency to be worse and longer lasting if people are highly mortgaged or companies are highly leveraged. That's not the case now. So this is actually very, very good. And that's why if we do have a recession, they say it may be like the other ones, it may not affect people as much. The other part is, and we're going to probably see this happen, we're about a 5% pullback. There's something called the Powell put, Jerome Powell being the head of the Federal Reserve. Normally you have about $2.4 to $2.8 trillion of cash and money market accounts. But really since 1920, this has really spiked up. And this is the Federal Reserve pumping money in our economy. And so until this money is spent and goes away, you're going to see people buying into the dips. So that's why it was really hard last year to do Roth conversions. By the time we get everything ready to go, the market pops again. I think this year it's going to be a lot easier to do. But this is going to help kind of keep our head above water if there's drops in the marketplace. What about the negative aspects? What are some down things that may happen, to our economy? And one of the biggest down parts is, geopolitical. We don't have any slides on this, but Putin is very upset with the NATO, the United States making noise over Ukraine. He does not want Ukraine to become part of NATO. And a fact a lot of people are not aware of is, who cares about Ukraine and the United States? Is that really a significant country that we should get involved with? Do we really want to go to war with Russia? And the way to look at it is, what if Mexico decided to get real friendly with China? Would we be happy about that? So I think there's a lot of really negative repercussions if we get into a battle with Russia over Ukraine. The other part is we have the Olympics starting up here next month in China, and China has made a lot of overtures about wanting to bring Taiwan back into the mainland like they did with Hong Kong. And if that happens, you may have two military events occurring simultaneously. And let's just say that our leadership and our government is not as strong as it possibly could be. I have a lot of concerns about what we're going to do. A lot of times when presidents' approval ratings are really bad, they like to start a war as a deflection. Bush did it, Clinton did it. Trump was the first president who never got us into a war in I don't know how many decades. But a lot of times they do that as a distraction. But that would have a negative impact on the markets short term, and depending on if it was a hot war or short war, would have an impact. But that's probably one of the biggest wild cards over the next, say 2 to 3 months. The big challenge we have with inflation is if you have $100,000 in a savings account, you need about $5,000 just to break even. And you're getting a whopping $70 on a $100,000 investment in a savings account. So the banks aren't paying anything. But when they raise interest, when interest rates go up and prime rate goes up, those prices go in effect immediately. The savings amount increase really lags. So it's very elastic up with rates, but in terms of savings, it's very inelastic. So the problem is people can't get enough income on cash to pay their bills. And even though the account doesn't go down, with the impact of inflation, it becomes a huge problem. And we've talked about this slide many times about our 3 option-heavy portfolios. Again, what we say we'll do on a $1 million portfolio, this is the amount of cash we generate. This is the trailing 12 months and the amount of cash it's generated. Now, this next slide we have is kind of shows what the alternative is. And what we have on this particular slide is this is taken from our stock income on the amount of income you can generate. So on a $1 million portfolio at 1% will generate $120,000 per year. And what we added here is if you take your traditional 60-40, 60% equities, 40% bonds, how much money would you need to generate the income? And what we have here, you have to have $5 million to generate $66,000 of income, where here at $1 million, you're generating 120. So if you had $5 million in stock income, you generate $600,000 a year of income. And the risk metric of this portfolio and stock income are about the same.
And Mitch, that's that number 4 bullet point on there with the
Yep.
with the S&P yielding 1.4% and the aggregate bond yielding 1.24%.
Yeah.
So that combined 60-40 yield gives you 0.11 per month. So by doing a call writing portfolio, that target, you're saying, okay, I got to work 10 more years. I need to get this X many more hundreds of thousands or millions of dollars. Well, do you really have to meet your goals? The volatility of the S&P last year versus the volatility of our stock income portfolio, the S&P was 3.2% volatility. Volatility equals risk, everybody. So S&P as a whole was 3.2. Our stock income portfolio was 2.73. The combination 60-40 volatility was 2.25. So instead of a 60-40, 2.25 volatility, you can go up to a 2.7 volatility, and you're looking at this difference in generation of income. So yeah, you are going to take on a little more risk, but it's for my mom, it's been a lifesaver.
Yeah, and for a lot of the clients on this call, it has been as well. So that completes our presentation. I'll go and stop the recording now.